Welcome back to Understanding VC. I'm your host Rahul. Today my guest is Shwetank Verma. Shwetank is a co-founder and managing partner at Leo Capital, an early-stage VC firm based in Singapore, investing in technology-centric opportunities in India and Southeast Asia. Prior to his role at Leo Capital, Shwetank was a head of open innovation at MetLife Asia, and he also served as an advisor on open innovation to several Fortune 500 companies. Now let's talk to him. Hi Shwetank, thank you so much for joining me today.
Hey Rahul, great to be on your podcast. Thanks for having me.
I would like to know, where did you grow up?
Yeah, it's a great question because I sort of grew up between different places. So I did my large part of my primary schooling in the UK in a town called Reading, which is a small town near London,
Yeah.
and then I did my secondary, my higher schooling in Lucknow, which is a small town in North India, and then I went to university in the UK. So I grew up in between these two cultures, India and the UK, more in India, but very key years in the UK. So a bit of both.
Yeah. How come? So your parents were working in the UK and then they decided to come back to India, or?
My parents were in the Indian government, so they had some sort of posting in the UK for a bit, then they came back to India.
How different was it like growing up between UK and India?
Oh,
Was it
that was
difficult for
chalk
you
and
to
cheese.
adjust?
Yes, I always say that, one of the toughest things was moving back as a 12-year-old. So that set me up for life. Moving from, London to Lucknow at 12, pretty life-changing experience. So I moved, I'm dating myself here, moved in the early 90s, where in Lucknow at the time, you didn't even get a can of Coke. So, and you didn't have the cartoon shows, nothing. So it was a massive change for me. But I enjoyed it, after the initial shock. It was great to be back home. And, I enjoyed my 6, 7 years in Lucknow before moving back to the UK at the age of 18.
Yeah. And what were your interests growing up?
Yeah, I always enjoyed the sports quite a bit. So I used to play cricket and tennis regularly. I think that was the majority of my interest to the concern of my parents, who were always asking me to study more. But I enjoyed sports
Yeah.
and I enjoyed entrepreneurship. So always, early on as a 16-year-old, I was one of the first to have a CD burner in Lucknow, and we were running a small CD burning business. So I enjoyed the process of creating something even as basic as CD burning, but trying to create some cash, some capital. So I enjoyed entrepreneurship from an early age. So that was an early interest. Sports was another interest, and then reading was the third and final interest. Reading non-fiction, not my studies, unfortunately.
Yeah. I used to do the same thing. I used to make copies of games and then sell it to friends to make money. And
Yeah,
then
those are
the
good old
thing
days.
is that I did not have a CD burner. I used to go to a shop to get it done, and then it was like an arbitrage.
That's the even harder path.
Yeah. In the end, how did you end up in venture?
So I think it was a natural progression for me, Rahul. I built and sold a couple of companies. I worked as a investor at a large family office. I, worked as a innovation person in a large Fortune 50 company. And I think, bringing all these experiences together, venture was the most natural home for me. I didn't have the desire to do another startup. It requires far too much effort. It requires a lot of effort, a lot of energy. And I've done that a
Yeah.
couple of times. So I knew what I was lacking there. And the opportunity is really now in India and Southeast Asia. The next 10 years I think are going to be fantastic for startup, even given the macro conditions and all the toughness that's going on. There's so much opportunity on the ground, so it felt like a great time to
Yeah.
start a venture firm, and that's how I ended up in venture. We started 5 years ago, so it's been 5 years.
Yeah. Yeah. So, in your opinion, right, what startup advice seems obviously right? It's relatively easy to follow, but usually ignored.
Great question. I was just with my doctor today, and he told me you need to eat less and lose some weight, right? Classic, easy advice to
Yeah.
give, relatively straight. Well, not
Yeah.
that easy to follow, I guess, but not that hard either. I think in startups, at least
Yeah.
what I tell my portfolio companies is don't treat fundraising as a competition. It's not about how much money you've raised. It's about, what products you've shipped, what problems you've solved, what market traction you've achieved. I think a lot of entrepreneurs, especially compare their raises with companies in the same space. And they're like, if they've raised 15 million, why have we only raised five? Or if they've raised five, why have we only raised one? And I think that's
Yeah.
the easiest thing to get out of your head as an entrepreneur. There is no reason to think that the volume of dollars raised is determinative to your outcome, at least at the early stage. Between
Yeah.
5 and 15,
Yeah.
you can still win in a market if you've got a better approach to the problem and a better product. If your competitors have raised hundreds of millions, yes, you might be a little late to the market. But at the early stage, I wouldn't compare that they've already got to their series A. I am still at seed or something like that. So I think that's the easiest advice. I think there's a lot of advice around this out there, but for whatever reason, a lot of entrepreneurs treat fundraising as a competition, and whenever somebody else gets funded, it becomes, oh my god, I need to raise my next round.
Yeah. Yeah, the real competition should be really about building something that somebody want with the least amount of money and least amount of time. Even I fail to do so sometimes. It's not easy to yeah, really do that consistently.
So I think going back to your question, right? Is there any advice that's easy to follow? I don't know, but this is one of the relatively easy advices to follow.
And also, could you share with me? So you have a number of portfolio startups already, and could you share with me like an example of a scenario where you've helped a startup navigate a very difficult situation or make a difficult decision? And there are a lot of those scenarios going around, especially at this point of time.
Yeah, yeah. I think one of the things as a VC is that your ability to really do a lot is quite limited. I think the bigger role here is just support, counseling, be open, listening, try not to judge. But you do, occasionally you can help um, in ways. I think this current SVB disaster, of course, is a tangible example, right? Where VC is one of the
Yeah,
key things we sell is our Rolodex, right? Our network. So I think over here we were able to
yeah,
do some interesting things around, creating, for instance, we're working with a insurer to create an insurance product which actually increases our startups insured deposits way above FIDIC levels, right? So that's something, it won't help
yeah,
immediately, but it's an interesting sort of thing that we are going to offer all our portfolio companies. In the immediate aftermath of SVB, sort of helping founders open new bank accounts, get introductions, and move money around and all of that. But these are more tactical things. I don't think they're that transformative. I think the thing that we really help founders in, or which is the really tricky situation, is when you're having founder conflict. And I think they're helping founders decide how to move forward, because two founders or three founders fighting with each other can never build a generational company or a lasting company. And I think they're helping founders. I don't want to name the companies, but quite a few times we've helped founders disentangle that situation, right? By either buying secondary shares from a founder, helping create the right exit paths for at least one of the founders, so that everybody else can work in harmony and grow the business together. I think that's been the thing that I find the most challenging to work on, but also the most satisfying once it's resolved and the companies start to grow dramatically.
yeah. What would be an example of this?
Yeah, I mean, the example of this would be, let's say they're two co-founders and they're sort of really not getting along, right? They need to
Yeah,
sort of go separate ways. So the over here it would be actually spending time with each of them individually, figuring out who is actually more committed uh, to the future and the vision of the company, and then helping the other one accept that he or she needs to move on and finding the right exit path for them. That's what this kind of helping the founders amicably, as possible, as much as possible, amicably go their separate ways, so that the company and the original vision, or whatever the pivoted vision is, can grow. That is, I think, an area where especially a lot of early stage startups require support sometimes, and it's something that if you get it right, can really transform the trajectory of a company.
yeah. Has there been a scenario in your experience where you had to completely replace the founding team?
So I think that we are seed stage investors, Rahul. So I think if you are ending up with a complete replacement of the founding team, it's over. The
Right.
companies are too small for
Yeah.
founding team replacements. So we haven't done that. Touch wood, we never had to do that. And I think only a couple of companies where we've had to deal with founder conflict also. We spend a lot of time actually before an investment to make sure there is no founder conflict, or there is there are
Yeah.
pathways that are established in the founders agreement, etc., to resolve founder conflict. But it's an inevitable part of life, so it happens. And I think being on top of it and solving it as quickly as you can changes outcomes for the company.
Yeah.
But we never replaced a founding team. We have no desire to replace a founding team. And my belief is that if you're thinking about replacing a founding team at seed or series A, it's better to shut the company, return whatever cash there is, and try again.
Yeah. And you spoke about spending a lot of time with startups before you invest. So, what do you think startups can do to do their due diligence on VCs very smartly? What should be a startup's approach be?
Yeah, it's a good question. I think there is a lot you can do as a startup. So I think simple, of course, read the website. I can't tell you how many D2C startups still pitch to us. When there's on our website, it's clearly written we don't invest in D2C. We don't do brands. We only invest in technology startups. So start with a very simple that this is it's like a you can think of it like a job application. You can think of it like any place where you're trying to put your best foot forward. So you should read the website. I think it's a very simple, not that time consuming task to do. You should, to the extent possible, read or follow on the, lot of VCs put a lot of stuff out on Twitter, on LinkedIn. So just follow, read that. I think some of the most effective cold pitches are when you read something that the VC has written and you reference it in your pitch and say, "Hey, you talked about this problem. We're solving it. Here it is." At least for us, I think a couple of companies have converted because they use that cold approach to reach out to Rajul or myself on something that we'd written in Twitter or LinkedIn. The third, once you get so that I think that's the easy thing about how to think about VC as you're approaching them for investment. Let's see, you've had a conversation, it's looking good, and the VC is giving you a term sheet. At that point, you really need to diligence the VC. And I think very few startups do this. And it's important to do because you are signing up for a long time with this person, with this firm, and you want
Yeah.
to know how they are in adversity. Because there is a lot of behavior which can be really destructive in adversity. And as a founder, I dealt with it. As a VC, I want to make sure I never be that kind of person. But every founder should sort of do their diligence. And the way to diligence VCs is to talk to their portfolio companies. You can ask the VC for references to founders. You can reach out directly. Most founders are fairly open to responding to people. If you send them a message saying, "Hey, we've got a term sheet from Leo Capital, we just want to talk to you about your experience," I think most founders will respond. And if the founders don't respond, that itself is a red flag, right? You should read something into that as to why founders are not responding to a request for ref check. So before signing, final docs,
Yeah.
etc., you certainly do ref check with the portfolio companies to the extent you can, and be comfortable with both the firm and the partner who is joining your company, potentially your board, and understand that it's a two-way process. I think a lot of founders, because there's still a scarcity of capital in our ecosystems, if you're giving a term sheet, most founders say, "Okay, let's take it." But you shouldn't do that. You should certainly do some more diligence. You should make sure you're truly happy to be working with this person for the next 5 to 8 years before you sort of accept the investment.
Yeah. A couple of things. I'm really happy that you said that people should read what the VCs write on LinkedIn or other places. That's the fundamental reason I do the podcast, because I expect founders to listen to this podcast once it comes out, just to get an understanding of who you are and what you look for. That's the need that I am fulfilling here. And the second thing also you mentioned about, if a founder don't respond to you, that's already like a bad sign. So can I ask, like, is founders really incentivized to share his or her details, like, or experiences of a VC, very openly? Because this is a very, very small ecosystem where everybody knows each other, right? So do you think you can really get the truth of what a VC is like from the founders?
I think you can in a one-on-one phone call or a one-on-one meeting. I certainly think you can. I don't think you're going to get it on
Okay.
Twitter. I don't think founders are going to, especially negative stories. I don't think you're going to get on a public forum. So yes,
Yeah.
I wouldn't I wouldn't ask the. You shouldn't do a diligence call on a recorded call or a podcast or something like that. But I think if you ask honestly, my sense is, at least as a founder, when I was a founder, I was very honest about it in one-to-one conversation. So I think most founders, especially if there's a negative experience, most founders want to make sure they don't perpetuate that. So you should get, you should be able to get, real answers from founders in a non-public one-to-one phone or ideally face-to-face setting.
Yeah. And what do you think are some of the most effective ways to, or the right approach to reach out to VCs? Is it still through warm introductions or?
Right. So it depends on the VC, I guess. Like we answer every cold email that we get. 100% of cold emails are answered, reviewed and answered. So for us, the simplest way to reach out to us is write to pitch@leo.capital. It will be read by a partner, and a partner will review and respond. So there is no need for a warm intro. There is no reason for anything special to do uh, to to get in front of us. Yes, it's great if you've read our website and you know what we invest in, so you're able to sort of grab our attention quickly, and you don't send us things that are completely out of our wheelhouse. But even if you send us a D2C, we'll send you a one-liner back saying, "Hey, this is outside our scope of investments. We don't invest,
Yeah.
in this space." So that's for us. But more broadly, of course, we're all humans, so warm intro always helps. I think what a warm intro does is gets you to that first call level. So I don't think it
Yeah.
helps more than that. So you still need to have a very solid business. You still need to have a very solid approach to a problem that you're solving, and the problem itself needs to be meaningful. But a warm intro will probably get you a call, and uh, s- at, conversation, that at least that conversation, which if, you may not get if it's completely cold. But if the company is not investable, you'll still get a no after that call. So the warm intro doesn't change your, I don't think it changes the odds of an investment. It just changes the odds of the first call.
Yeah. Yeah. The idea is, the goal is to get the first call, right? So, what are some of the best practices in terms of like the email that you write, and also the way you design or prepare the pitch deck to get to that first call at least?
There's a lot of stuff out there, I guess, on this. But for us, it's, I think,
Yeah.
simple. The best cold emails are, this is the problem I'm solving. This is why it's a large problem. And this is sort of the high level approach we have. If you can write that in 3 paras in the cold email, that will make sure we open your deck, which should have some more details about the team. And then, we'll get the first call. I think the simplest thing that founders can do to improve their pitches
Yeah.
is improve the team slide. The team slide in God knows how many pitches is photo,
Yeah.
LinkedIn, and some logos. It tells me nothing, right? Yeah, you went to Harvard, fantastic.
Yeah.
Like, why should I
Yeah.
care? So, I think that's,
Yeah.
and this is an epidemic.
Yeah.
Every slide is like this. So, make that small change there. Just, if there's a logo, talk about why that logo relates to the problem at hand, or why your team slide is a chance to get your founder market fit across, right? So make it to do that. And adding LinkedIn buttons does not do that. So yes, you can have it if you really want it, but ask yourself the question: is my team slide conveying founder market fit? And if it is not, redo it. And I assure you, mug shots with LinkedIn buttons, it does not convey founder market fit. And I think one more thing that a lot of teams do is add a lot of advisors and a lot of sort of part-time people and all of that. Again, that is not helpful at the seed stage. So, if somebody's not full time, or if, unless there's an absolutely world class advisor, ignore the advisor slide, don't add it. Focus on your problem, focus on your solution, and really tell me why you're the right team to be building the solution.
Yeah. That's wrong in the sense, like, you're just telling that, I need to show the names of so many other people. It is not like really selling yourself.
Exactly. And it's startups are built on the core founding team. Advisors and all of that have limited sort of value to be added at this stage of the company. They come slightly more handy once you get to Series B onwards, right? They can open more doors, etc. So that's my belief, at least. Focus
Yeah.
more on the team slide. You can really stand out if you move your team slide into a more interesting document than what most startups do at the moment.
Yeah. Yeah, and I know that InsureTech is a area of interest for you. So I don't know much about InsureTech. So where is the real value add for InsureTech? For example, I can clearly see what has happened with the payments or the India stack, especially in the India, how it has made everything very inclusive and cheaper for just about anybody and more convenient. And similar things are happening with credit with the account aggregator and stuff. So where is a real value for insurtech?
Yeah, it's a good question. So basically, if you think about it, the overall financial services, right, basically allow you to earn, save, and protect, right? So payments, etc., payments, lending as well as on the earn side. And typically, most people need to earn before they need to save, before they can save. Then they need to save before they can protect. So that's why you've seen that the initial wave of investments, etc., were all on things that are lower down that stack, right? So everything is in lending, in payments. You're seeing now more and more in wealth management as more people get enough to save, and finally insurance is coming to finally protect what you have and give you a safety net. So that's the sort of way to think about why insurance has been a bit behind, say, payments, credit, etc. What it can do is really similar to what tech has done in payments, in credit, and all of that, Rahul. So the core is it. I think the core is it reduces costs and increases convenience. That's true for digitalization across all sectors. It holds true for insurance as well. Insurance specifically is a data driven product. So the more data I have about you, the more I can understand the risk that I'm underwriting and how to price it more effectively. So much like thin file, people are being underwritten on mobile phone data and credit. You're able to create insurance products based on this data, and that is what InsureTech is about. So InsureTech is about using data and using mobile to basically create an offer and create access to products that very, very hard to otherwise distribute to the masses. So the way to think about it is that typically an insurance product needed a significant sort of size, a premium size, before it became viable for feet on the ground distributors. So you couldn't have micro insurance or cheap products because they were just not economically viable if you had to pay 50-60% to a distributor. But with the mobile, with insurtech solutions, you can go direct or you can go through embedded solutions, right? Embedded insurance is a big thing these days, where because of the
Yeah.
volume and because of easy to sort of or default attach and all of these things, you can bring a lot more volume, reduce the commission per policy, but still it becomes meaningful enough because the volume is higher, so it makes sense for everyone. So that's why I think that's sort of the exciting thing about insurtech at the moment. Allowing a lot of India and Southeast Asia is still new to insurance. It's like 10 years ago, most were new to credit. Now most are new to insurance. So I think the uptick you saw in credit, you should see a similar uptick in insurance. Just it won't be as big because everybody wants a loan, but not everybody wants insurance.
Yeah, I think, and also there are a lot of similarities between this embedded finance and, like you're saying, embedded insurance, right? The approach is kind of similar, and also similar to fintech, getting a license for insurance or a banking license, it's still similar challenges, right, from a regulatory perspective.
Yeah, I mean, so regulatory perspectives, typically there are different regulators for the banks and insurers in all countries, but it's the same challenge to get license. So regulation is interesting, right? It's a double-edged sword. If you get the license, it is a moat. It does help you, it helps you do things that you can't do otherwise without a license. And in these markets in India and Southeast Asia, it's still helpful to be able to be like have that license to say like a bank, right? If you have a license, you can take deposits, your cost funding goes down, and that is a competitive advantage to a fintech which cannot take licenses if you're both tech first, right? So there's a lot like in India, a lot of small finance banks which are more tech enabled than the legacy banks, and are, I think, interesting opportunities as to how fintech and traditional finance intersect. Similarly, I think digital first insurers like Echo and Digit are showing great progress because they are, they have full licenses and they can take the underwriting profit whenever they make it on their own account, compared to those without the license. So yeah, I think it's tough to get regulation.
Yeah.
It requires a lot of capital, but if you can get it, if you're on the other side, then it can be a great moat for growing tech companies.
Yeah, but what about the problem of trust? So I kind of feel that for a lot of neobanks, establishing trust is a challenge. So is there similar issues, or like what are some of the challenges that the startups and insurtech generally face?
Yeah, I mean, I think
Now,
the
other than
challenges are
regulation, of course.
yeah, challenges are very similar to the fintech space, Rahul. So distribution, trust, adoption, sales, all of the same sort of challenges. So the easiest is to sell a loan, right? Because you're giving money, so people are obviously, there's no
Yeah.
trust required to take it if you're giving me money, and that's the easiest. And it goes higher from there, right? A bank, it's harder because you have to trust them to keep your money safe, give it back. Now there is government insures certain part of your deposit and all of that, but still you have to work on making trust. Insurance is the hardest because it's just a promise, right? I take your premium today and I promise that I will pay your claim when you need it. And there's a history of claims being denied. So a lot of lack of trust in insurance in any case. So there is no easy answer to that. Building trust takes time. Building trust is a function of proving that you make good on your promises, and that's why claims are the most important part of a new insurer, or for a newer bank it's slightly easier because a newer bank can give you a loan and start that relationship, and it's slightly easier than an insurer. But for an insurer, it's important to pay out at least the claims that they get initially and make a big splash about it, right? Let everyone know that you're paying these claims, you have a high claim payout ratio, etc. Pay claims at the edge, right? So those, like, maybe a traditional insurer may refuse that claim because it's 95% it's there, but 5% is missing. But pay it out as a new insurer. It costs a little bit, but it helps you build that trust where over time then you can become more you know more rigorous in your claim payouts. But getting that right initially is key to building trust.
Yeah. And also, can I ask specifically regarding health insurance, right? So let's say something like India, a health stack comes up where, even insurance companies have access to your entire medical history. That would be a net positive, right? I mean, I've seen, I remember people telling, this would increase my premium, and this would be like a disaster and things like that. But I feel that, there's no point in hiding, right? But when it comes to claim, they're going to do a forensic audit on everything that has happened, and then you're not going to get the claim anyway. So this is going to be a net positive, right? In your
Yeah, at a
opinion?
societal level, it's going to be net positive, right? So if I take everyone, it's going to be net positive. But for individuals, it may not be. If you have terrible health and you were doing some, you managed to obfuscate your data or something and you got coverage, it happens, it can be done. But yes, at a societal level, it's a net positive. And I think it needs to be coupled with ways for making insurance affordable for those who have a lot of you know uh, pre-existing conditions and things like that. So how do you manage that? That's a trickier one to answer because if it's left to purely market forces, potentially the premiums will become unaffordable for people with multiple diseases or pre-existing conditions. So there needs to be like a taxpayer funded safety net as well to truly manage this, but that can come later. I think rolling out health stack, allowing the different insurers access to the data so that you can truly differentiate on underwriting. See, it's what the way you use the data is actually the core differentiator of in this kind of model. So I think it's great to make the same data available to everyone so that those with better insights, better ability to use the data are able to actually create the best products. So I think the health stack, as it scales up, is going to be a great, uh, well, for want of a better word, great experiment into how insurance companies
Yeah.
deal with standardized data and standardized, raw materials from which they have to extract value and change, create outcomes. And I think also the health stack creates a lot of incentives for insurers to create value added programs, right? So once you know all my history, You can predict a little bit more.
Yeah.
Okay, I'm at higher risk of say heart disease 5 years down the line. So how do you nudge me and make it easier for me to have better behavior today, so that my heart risk you know goes further 10 years out, 15 years out, rather than 5 years out.
Yeah. I read an article that you've written, I mean, a LinkedIn post that you've written on a similar topic on health, where, yeah, behavioral change is the only way.
So lot of the costs on health insurance these days are from metabolic diseases like diabetes, and there is no, at
Yeah.
least for now, there is no solution. Tomorrow we come up with a solution, we do gene editing or something, then all of this changes. But today, if you're diabetic, it gives you way higher chance of kidney disease, way higher chance of heart disease, and India is the diabetes capital of the world, right? So for now, there's the only real path is behavior change and systematic behavior change to reduce your long-term risk. Otherwise, we'll end up with a situation where it's just becomes more and more expensive to insure. And insurance, if you've seen, health insurance has been inflation in health insurance has been galloping because people's chronic diseases are just not under control.
Yeah. What about the state of venture in India in 2023? So it's been like 2 decades, close to 2 decades since venture really started as an industry. Where are we, and what are the positive changes that you would like to see in the Indian ecosystem? Yeah, VC ecosystem.
Yeah, great question. So I think we are in our teenage years now. So we're past the early childhood, and it's uh, time to get serious, right? So I still think it's the potential is ahead. Like any teenager, the future is ahead of you, right? So the peak potential is still coming. Say 10 years down the line, over the next 10 years, you're going to be the peak performance. Uh, Personally, the what we are seeing is phenomenal teams. So this is a great time to be building in India. So I think a lot of people have seen the first generation of hyperscalers. So you're seeing a lot of teams come out of say Flipkart, Paytm, Misho. They've all seen what scale looks like. They've all seen what good looks like, and that is a huge step up from the founders who were building Paytm, Misho, Flipkart, who didn't have any of these playbooks. They hadn't seen, right? Nobody had built a scaled up technology company other than sort of say Infosys or
Yeah.
Tata consultancy services. They hadn't built product companies. So that's one big change. So fantastic set of entrepreneurs who've seen a lot of scale and a lot of good things building companies. That's one good thing. The public infrastructure is improved by leaps and bounds. So UPI, health stack, Jam allows you to
Yeah.
really
Both
create
digital and physical.
both digital and physical. More digital, physical I think still needs a bit of improvement, but it's getting there. But the digital infrastructure to build on is fantastic, right? So that allows you to scale more fast, scale more rapidly, and hit the milestones that are needed faster as an ecosystem. Otherwise, we as VCs, we need to create more exit opportunities. And again, it is good to see companies like Zomato, Nika, etc. list. I think we need to see many more of those kind of companies list and maintain their stock prices, and of course grow, etc. in in the Indian Stock Exchange. One challenge now is that with the cost of money going up, everybody needs to think about profitability a lot harder. So there was a question, what's your path to profitability? These three words, path to profitability. I used to hear them a lot when I was doing investing in 2010, 2011. Then they disappeared. Nobody used to ask that question for last 3, 4 years. That
Yeah.
question has come back, and it's important for founders to think more closely about that. Growth for growth's sake does not work anymore. You need to make sure your unit economics work, etc. I think those are the things. So it's very positive, great talent, great opportunity. It's the largest sort of growth market that there is in the world now. US and China, outside of the US and China. So I think a lot of generational companies will be created over the next 10 years. We are very excited to be backing all these founders who are coming out, who are sort of building for tomorrow's India. And I think, you know, the government has been vastly supportive. It's all good. There are a few things here and there, like the angel tax, etc., which I'm sure will be cleared up and can be made slightly more friendly to startups. But on the whole, there's a lot. I think the positive side of the ledger is a lot larger than the cons at the moment.
Okay. Yeah. In terms of things like angel tax, do you think that would be fixed soon from a regulatory perspective?
I mean, I don't have any insight on whether it'll be fixed soon. I really hope it'll be fixed soon. I think it's not conducive for startup investing, specifically, bringing money in from outside. But let's see, how it goes. But I hope it's fixed soon.
Yeah, I mean, doing that in the US was exactly the reason why the venture ecosystem like really took off, right? There was a lobby who kind of managed to get a lot of tax breaks for venture investments.
Yeah, for venture investments, for VCs, for entrepreneurs, the Roth IRA. There's a lot of things that happened in the US, which I think some of them that can, if you could implement in India, would be great. But you know, we'll see what happens here.
Yeah. And one last question before we end this: why the name Leo Capital?
Yeah, it's a great question, Rahul. So Rajul and I started Leo, and we locked ourselves in a room trying to come up with a name that we really liked. And I think we went through like about I'd say hundreds of names that for whatever reason we didn't like one thing or the other. And ultimately it came down to our we sort of we're trying different inspirations, right? So we came down to our sun signs, to and I'm a Cancer, he's a Leo. So Cancer Capital just didn't work, right? I mean, I loved it. I said it's growth even if it kills you, but that for right reasons was ruled out. And Leo has the right sort of, you're the king of the jungle. You're aggressive but not crazy. So the lion, I think, appeals. And we were also based in Singapore, so it all added up together. So Leo Capital was born.
Nice. Yeah. Thank you so much for taking the time to do this.
Thank you. Really enjoyed the conversation, and best of luck with the podcasts.